All right, guys, in today's video, I'm going to go over the exact trade that made me over $10,000 today and how you can try to time a tactical bottom or a tactical top using this strategy called overextension move from the moving averages. So I'll break down exactly how this entry model works, how this entry strategy works, and how you can take advantage of it when the market starts to become overextended. I also want to talk about in this video how win rate does not matter as much as you think. Risk reward is one of the most important things, and if you can make sure that your winners are much bigger than your losers, no matter if you're in a slump, no matter if you have a bad win rate for the month, you could still actually end up making money with a 30-40% win rate by just making sure that your winners are super big. And this is why risk management matters so much. And in this video, we'll dive into that, we'll cover that, and I'll show you the exact trade that I took and how you could do the exact same thing the next time a trade like this rolls around. Let's get straight into it. All right, so let's get straight into the video. I'm going to recap the exact trade that I took and how you could look for these exact same extensions and overextension moves, and how you can use this entry model to basically time the bottom on some trades. Now, what I want to go over first is my P&L for the month, because I want to show you a little bit of transparency. At the beginning of the month, I had a really tough month. I had a few losers in a row. I wasn't gaining any traction on my positions. So what did I do? Well, I sat out for the beginning of the month. I did not take that many trades. When I noticed that a lot of my trades weren't working, I sat out because you know what? At the end of the day, if you don't have an edge in the market, there's no reason to put yourself in a position to take trades when there's no edge in the environment within the market. You always want to wait for the highest probabilities. Now, I know it's easy for you to get trapped in a sense of comparing yourself to other people. You might go on social media, you might go on YouTube, and you might see someone having an absolutely amazing day while you don't even know what's happening in the market. And what you have to understand is you never want to compare yourself to other people because you don't see their full journey. You don't see their full year, you don't see their full 5 years or decade of trading, you don't see what their journey is, and you don't know whether their strategy works really well in certain market conditions. All you know is how good you trade and what conditions work best for you. So if you're in market conditions that aren't probable for your strategy and you don't have high probabilities, what's the point of putting your hard-earned capital on the line and trying to burn yourself in these type of conditions? So what I always tell myself is if I start seeing that I'm losing 3, 4, 5 trades in a row, the first thing I'm doing is sizing down no matter what. A lot of people try to size up and make back for their losses on 1 or 2 trades, but all that does is it's going to give you a deeper hole, and it's going to dig you a deeper hole because you already know the conditions you're trading in are probably not going to work well. That doesn't mean that, sizing up is going to get you out of that. It's actually going to dig you a deeper hole. So just make sure you're doing that. And I want to kind of help everyone understand, these slumps will happen, but the most important thing is making sure that you are managing your risk, because you could see right here, one good trade, and this isn't like a lucky trade. This has nothing to do with luck. It's just the fact that the risk reward and the math makes sense. You're going to have a few trades where maybe you're going to lose 10, 15% when you're trading options. And then one trade is going to end up running 80, 100, 150, 200+% because our risk reward is so good that it will wipe out all those losses and more. So even though I had a negative week, I had a $5,000 loss on the first week of November, just one trade covered that plus double in the week of, this week right here, the second week of November, right? And this shows you how good the probabilities are. So the trade that I took was on the ticker IONQ. You can go right here. You can see it was the 48 call for November 21. And this was a net ROI of only 50%. The whole trade only made me 50%, and I was still able to cover $9,400. Whereas, a trade that I lose 5, 10% on, I'm losing maybe $1,000, right? $1,200, $1,500 because my risk management is so good and my stops are so tight. So what did I look for on this trade? This is going to be something that we're going to cover on TradingView, and we're going to go over exactly how you can use these type of reversal extensions to make a buttload of money in the markets. So the first thing you want to do is you want to get an idea of where the markets are, right? You always want to see what the market is doing. I always base my trades off the market. So for the last few weeks, it looks like the market's kind of been chopping. It hasn't really been making any new highs, right? It hasn't really been making any new lows. It's kind of been in this range and building out this kind of box range. And when I start noticing this and the market starts going sideways, that tells me right off the bat that swing trading, momentum trading, trend trading, it's probably going to be a little bit tough, because when there's no trend and the market just going sideways, you can't really hold a single position to one side for that long, right? Because you're not getting any really new highs, no new lows. So things are just kind of going sideways. You're not getting a lot of momentum. So when I start noticing that, I'm trying to think outside the box, right? What can I see in the markets to potentially give me an edge? So what I saw was something called an overextended reversal extension. So meaning that the market was a little bit overextended to one side, and it was setting up to potentially reverse very strongly the other way. So the NASDAQ was down 3 days in a row. So it was red this day, it was red this day, and then today we gapped down 1.5% in the morning under a key moving average, which is the 50 EMA. And when that ends up happening and you have 3 overextensions in a row, usually you have a mean reversion, meaning you revert back to the mean, right? It's a little bit of an overextension. Kind of think about like a rubber band. If you get all the way at the end, you're going to bounce back a little bit. Once you pull that string all the way back, it'll expand and kind of bounce back in just to kind of put you back to, the middle, the mean. And this is what I was looking on the NASDAQ. And I was kind of going into the morning thinking, which are the most overextended stocks? So I made a list, right? So for example, I saw IONQ. Look at how much this is down over the last few months. 50%, right? 50% down. And it had 3 gap downs in a row, 3 down days in a row. It's extended from the moving averages. And then I did one more thing that's going to give you a ton of confluence on this. I turned on the 200 SMA. And notice IONQ, every single time this thing tapped the 200 SMA, it has bounced off of it, right? So we know this is a clear key level. We know this stock is gapping down into this level, and we know the market is extended to the downside. So what are the probabilities? Well, we can either chase with the rest of retail, we can be like the sheep, we could chase the puts, right, and play all the moves down, and have no real thought about what the market is going to do. Or we can ask ourselves a question: where's the probabilities in the market? Well, we're opening down 3 down days in a row, right? We're gapping down pretty big, about 1.5%, which is the average daily range of the NASDAQ and the S&P, kind of around that spot. And we're opening into a big key level of support on a lot of different stocks. Is this a time to get short? Probably not. It doesn't necessarily have to be a time to get long, but is it a time to get short? Probably not, because the probabilities aren't on our side. So when is the time to get short? Well, the time to get short is when the market is breaking through key structures like this, right? Not overextended. Once you've already made the move, you're a little bit overextended at that point, right? It's just like getting long after the breakout has already played out to the upside. So at that point, you don't want to get short. You're looking at, okay, what can we do for potential reversals, right? So that's what I was thinking about on IONQ. And this one was at the 200 SMA. It opened like that in the morning. Now, I'm not just buying randomly in the morning saying, okay, this is going to bounce. What am I doing? I'm waiting for a specific confirmation, and this is called a red dog reversal, an RDR. So what does this look like? Well, you draw out the previous day's low. And whenever a stock gets under a previous day's low and then reclaims that low, that is an RDR, which is a tactical reversal to be able to put on size and know exactly where to risk for a big pivot trade, meaning you put on a low risk, high reward pivot position. So what do I mean by that? Well, we bounced off the 200 SMA, we broke under the previous day's low in the morning, we reclaimed it. That tells you that all these late shorts right here, all these retail shorts that are so excited, they wake up in the morning, the market's red, they're like, oh, let's short. This is going to make a massive move lower. They're late, right? They're late to short this. And all the longs here, they've had so much pain where they're like, oh, not again, not another gap down. I'm going to sell. I'm going to sell in the pre-market. I'm going to sell in the morning, right? I'm finally out of this thing. And it's into a key level. Now, think about that psychology. What it adds to is fuel for a massive reversal. And that's exactly what happened here. So how do we actually trade it? Well, once we mark out the previous day's low, we come down to the lower time frames. So I like to use either the 15 or the 5-minute. The 5-minute is the easiest to nail down really good entries. And what we're looking for is just a 5-minute close over the previous day's low, right? Reclaiming that low. So the first 5-minute candle, you could see that's exactly what happened. We closed above, right? You have a ton of volume on the reclaim. Your stop loss goes to the low of the day. And then you just swing this into the declining moving averages. So where do we target? If you go on the daily, you target into the 8, you target into the 21 and the 50 declining moving averages. Now, I obviously scaled out of the position and took some profits into the strength because I am trading options and I only have a 1 week out expiration. So I don't want to hold this for too long, but that is my main target, right? But I'm trimming into the strength as this continue to make new highs. And then my stop loss is only this low. So look at the risk to reward that I'm getting on this trade. If it runs all the way to my target, which it obviously did, I'm getting a very good risk reward on this thing, about a 3 RR, right? And if it continues to go higher in the next few days, which it looks like it is in the post market, it looks very strong, it might get to a 5 or a 10 RR. And then this is going to be a massive trade. And I only put on a very small amount of risk at the low of the day. So that is the trade that I took. That is how you play these mean reversals and extensions. And sometimes you want to be like smarter than the rest of the people, right? You want to sit down and really reflect and think, is this a good time to get short? Or is this a good time to potentially look for a reversal in the markets, right? And that's exactly what ended up playing out. So I'll show you a few other stocks that did this exact same thing. Here's Oracle. It came off the 200 SMA. Look at how extended this thing is to the downside. Everyone here is shorting, they're late, and then boom, it reverses. And look at the volume. This confirms to you that there's going to be a pretty big reversal. Now, keep in mind, this doesn't necessarily mean that this is going to start a new uptrend, right? This is a short-term bottom. It could be a long-term bottom, but it is a short-term bottom, and that's the trade. You're just playing a mean reversal. It's not supposed to be like a long-term buy. It could turn into one as long as you have cushion and this thing holds, but that's not the point of the trade. It's just supposed to be, you're looking for a reversal. But this one played out beautifully. So you mark the previous day's low, like so. You go down on the lower time frame, 5 minute. The first 5 minute candle that closes above, which was this one right here, you enter, you put your stop loss at the low of the day, and then you swing this thing into the declining moving averages, and you see you get an absolutely massive move. You could also play this on the retest. So a lot of times you might miss the original pop above, or you might see the stock a little bit later in the morning, and then you could see it retest into the level, and then that's where you buy right here, right, with the stop at the low. And that could be a beautiful mean reversion. Another one, look at Tesla. Massive mean reversion. At some point, this stock was down to $380, and it ended up at $411. That's a $30 swing on this stock that you could have potentially caught, right? Mean reversion, it's right off this spot right here. Gets a really nice move to the upside. Another one, PLTR. Look at this one. Undercut the base right here, reclaimed the previous day's low, ran all the way into the declining moving averages. Would have been another nice one to catch. So these don't come often, but it's a great skill to have. And if you have this skill, look at what you can catch. I actually caught this April 7th bottom because we had 3 down days in a row, extended from the moving averages. And on the NASDAQ, we were retesting the previous all-time high. So this is a massive level of support. And when you can combine these three things together, overextension, right? 3 down days in a row, specifically gapping down is even better. And then a big level of support, and then reclaiming the previous low, you have a recipe for absolutely beautiful success. And I got long here on a bunch of stocks, put my stop loss at the low. The next day obviously was red, but I didn't get stopped out because my stop is at the low, and that's why it's important to put your stop loss at the low. And then I caught this beautiful uptrend on a ton of different stocks by being able to take that low risk, high reward entry. And that's the whole goal of trading. All right, guys, so that's going to be the video. Hopefully you found value from that and you're able to understand these entries and catch these the next time these setups set up. If you want to learn exactly which setups I look for and how to find these specific things, I have a 10-point perfect trade checklist down below that you guys can download for completely free. So if you want to go check that out, you want to go find some of these setups, you want to see like the A+ criteria that I look for, just go down below and download that checklist. And I promise you, this just one checklist can change your whole trading going into the year of 2026. Now, if you enjoyed the video, also please drop a like button and subscribe, and I'll see you guys all in the next video.